now. Sanjeev Prasad, what is driving the markets higher? It's been a great comeback, and last 8-10 days of April have been nothing short of a dream run for the bulls. So what do you think bears have got it wrong and bulls have got it right? And a simple answer to a simple question, why are markets going higher? Are we missing on something?
I don't know whether what you are missing on, but it seems to be in line with our expectation at least. See, the thing is, if you look at what is happening globally, the number of COVID cases, they seem to be coming under some sort of control. If you look at Europe, for example, the number of new cases have come down pretty sharply compared to where they were 2-3 weeks back. Many parts of Europe are gradually opening up for more economic activities, schools, etc., also being opened up in some of the Western Europe countries. If you look at US, also number of cases are now starting to decline over the last 2-3 days compared to about 30,000 cases per daily new cases, which was the rate before that. So looks like at least, if it's coming under some control globally, which is making people hopeful that the economic impact of this may not be as dire as what we expected at one point in time, and it was expected that, this COVID situation will pretty much get out of hand. You will have, large parts of economies being, shut for an extended period of time. So thankfully, that doesn't seem to be the case. So it's clearly a situation of, global risk-on sentiment, also helped by the fact that many of the central banks have been very supportive of, in terms of their very loose monetary policies. Many of the governments have announced huge fiscal measures, anywhere north of 3 to 5% of GDP. In some cases, 10. In one case, even 20. So that's the kind of monetary and fiscal support one is looking at. So I guess that is rubbing off on India also. Specifically in India, the number of new cases thankfully seems to be not accelerating. If you look at the CDGR last 4 days, that is below 6%. April 15 to 25, the CDGR was more like 8%. April 5 to 15, it was more like 11%. So in a way, the extended lockdown has managed to flatten the curve. And other data point is many districts seem to be largely unaffected. So, the central government, state governments can take the call and now reopening some of these districts for more economic activities. Hopefully, we'll get to hear on that in the next 1 to 2 days. So it just, I would say positive sentiment stemming from the fact that the COVID situation seems to be getting some amount of control. For all all of us will be totally wrong. 2 months later, something else could have happened. You could have seen a second wave and all. But as of now, it looks like, it is getting under some control. Fingers crossed.
So what are you advising your clients? Should they remain invested, or after a 20% comeback in good large cap stocks, 15-17% comeback in Nifty from the recent lows of 7,500, is it time to book some profits?
It depends on your time frame. Yeah, if you're a long-term investor, it's okay. Stocks are still quite relative. I would say correctly valued on most parameters. When I say stocks, I would say most stocks, not all, because we have seen big run-ups in some of the consumer staple names, pharma names, which are now getting into fairly value territory, even on fiscal 22 basis. But most others seem to be reasonably undervalued, even after the big run-up in the last few days on March 22 numbers, assuming that we don't see further economic damage and earnings downgrades of an extended COVID situation. So if that is the case, then I think things look somewhat under control, I would say. Over the last 2 months, we have upgraded as many as 38 stocks now. So our call was that, when some of the stocks corrected significantly, we just took a more positive call saying that, look, there will be economic impact, there will be severe earnings impact for a year. But March 22 would be a more normal year, and logically, 1 year's earnings cut should not damage the fair value of any company dramatically. So that's the call we have taken. So far, touchwood, that seems to be working. We'll see from now, given the fact that the reward-risk balance is maybe not as favorable as it was, let's say a month and a half back. We may have to review in some cases. But broadly speaking, I still think there is money to be made in most of the names if you take a 12 to 24 month time frame.
Where do you think the economic recovery is going to be the slowest and fastest? And where do you think that there is going to be a kicker which would come in because of the post-COVID environment?
See, the slowest part is clearly anything to do with investment, because as of now, given the damage to the income of households, and even the government to a large extent, given the big drop in tax revenues we will see this year, and also the sentiment part, I would assume the three sub-segments of investment, which are government, household, and private sector, all three would be very reluctant to spend. So anything to do with investment, whether it is residential real estate for households, whether it is large infrastructure projects for the government, or whether it is any form of new capex for the private sector companies, I think that's off the table for the time being. So capital goods, cement, construction materials, all demand for that will probably recover last. On where demand could come back fairly quickly, and this all assumes that we will get back to a normal. When I say normal, obviously that's within quotes. Situation by let's say by end of September in terms of economic activity, etc. I would assume low ticket consumer discretionary items would come back a lot faster. So things like consumer durables, low ticket items, even two-wheelers, which is more of a semi-urban and rural product, particularly motorcycles. And from whatever we are reading, seems to be that the COVID impact is pretty limited over there, and the economic impact is also somewhat limited. So that could also come back, fairly sharply. Maybe even dining in, that etc. could also start picking up. Lastly, in the same bracket, I would assume global commodities would also come back, as the global supply-demand balance starts becoming better, because currently, or until recently, there was hardly any demand. But as various economies start gradually opening up, demand will start picking up, capacity utilization levels will start rising, supply-demand balance start becoming better. So pricing profitability will start improving from trough levels. So even that could come back very sharply. So that's how I would look at the various buckets of stocks. So you have stocks where the demand may not be impacted that much, which is your traditional consumer staple names, pharma, electric utilities, telecom to some extent, which are in the first bucket. Second bucket is where demand is impacted significantly in the, let's say, in the last 2 months and the next 2-3 months, but where demand could also come back a lot faster. This is typically low-ticket consumer discretionary, as I was talking about. And then you have the segments of the economy where demand is impacted significantly as of now, but will also take longer to recover, which would typically be anything to do with large-ticket consumer discretionary or investment part.
Okay. Sanjeev, the general or universal logic in the world right now is that, look, there is abundant liquidity, money is available at 1% or 0%. Money will chase returns will not come in US, Europe, or for that matter Japan, which means per force money will have to come back to emerging markets. Do you think there is merit in buying this good old golden thesis that a lot of money will get printed and money will come back to India and China because they are better off, A, in terms of environment, B, in terms of growth, and C, in terms of medical news?
I don't know, because as of now, the view seems to be that, Europe and US will recover faster than India, because it looks like as of now, they've brought things under control. China is anyway doing fine, but whether a lot of money will go to China, I'm not very sure, because there are lots of geopolitical issues and so on and so forth. Yeah, FPI money may go, but I suspect FDI would be limited. Now, coming to India, eventually, if we have so much liquidity, money will come. I hope it's in the form of, not just FPI, but more pertinently in the form of FDI. And that's going to be a lot more meaningful for India in the medium to long term.
Yeah. Sanjeev, the one thing besides staples that one can't live without, and one is witnessing that amidst the lockdown, has clearly been telecom. Just more and more screen time. That's what the data also has been suggesting at a global level, not just India. Suffice to say then that this telecom in specific needs to be a part of one's core portfolio right now.
Yeah, that's true. Anyway, we had a positive view. I think most people had a positive view on telecom even before the COVID situation, simply on the fact that it looked like ARPUs are bottoming out in the second half of last year. And if you recollect, in early December, you had a big increase in the rates by all the three large telecom operators. And I would assume that would continue because even at current levels of ARPU, it's not as if the industry is very profitable. So logically, I assume, ARPUs have to go up a lot higher from where we are. I think it would be more in the range of around 250 to 300 rupees eventually, ARPU that is, over the next, let's say, 15, 24-month time frame. Because that's the level of ARPU required for, the weakest operator, which is Vodafone Idea at this point in time, to be, somewhat profitable.
Sure. Are there obvious sectors, Sanjeev, that you got to avoid, the likes of airlines, multiplexes, even some of the few listed QSR companies that we have? Because I don't think anyone, unless extremely necessary, is going to be flying out or going to a theatre anytime soon.
True. You also have to always, put in the valuation overlay because the stocks I would say PVR has also corrected significantly. So demand will take longer to recover over there for sure. And you also have to be careful about any leverage entity in this space, where you have a lot of leverage and no, revenues at this point in time, because then the negative operating leverage will hurt, disproportionately. So you're right in that sense, these things will take longer to recover because it's obvious that, people are not going to be going back to their earlier habits very quickly. That will take a longer time. So some of these companies will also have to reconfigure the way they are operating. For example, multiplexes, you figure out your, some sort of a new seating arrangement, which gives people more confidence that, okay, fine, we have some amount of physical distancing from the next person and so on and so forth. And, I don't know, you'll have to think about some innovative ways of, for getting people back into crowded spaces and, people have, get the confidence that they are safe in these kind of environments. So clearly they will take time. But other than that also, as I was saying earlier, investment related sectors will take longer to recover because at this point in time, and I guess in the foreseeable future, next month, here I would say, whether it is the government sector, whether it's household, whether private sector, will have no ability and or willingness to invest in large ticket items. So, as of now, the whole focus would be on conserving cash, managing your consumption part rather than spending on large ticket items. So even that is probably off the table for now.
Right. Sanjeev, morning. Wanted to get in your take on, the infrastructure sector as a whole, because they have already been struggling, with dwindling order flows, stalled projects, etc. Do you think that they will be bearing the brunt of the lockdown impact far worse than some of the other sectors? What's in store when it comes to earnings, margin contraction, etc. as well for infrastructure?
You have to look at various parts of infrastructure. So things like, existing operating projects, they should be fine. If you have toll roads, I guess transportation activity will come back to normal by end of September. Ports, again, activity will come back fairly sharply. And, if the entities don't have leverage, they should be fine. But the real challenge would be for, entities which depend on new order inflows, that is, capital good companies, etc. So there, unless until you have a very healthy order backlog, and thankfully some of the companies like an L&T, for example, has almost 3 years of order backlog, they are in a better position, even if you don't see a lot of new orders coming in very quickly. But as you rightly said, infrastructure was anyway a problem even before the COVID situation. Now, obviously, things have worsened dramatically. As I was saying earlier, nobody will have the ability or the willingness to invest for some time. So everything, will get pushed back in terms of new projects. The existing projects should be okay, and unfortunately, the government, which was one of the biggest spenders in infrastructure, may not have the capacity to spend over the next 1 to 2 years, because clearly a fiscal deficit is going to go up sharply, even without any major fiscal stimulus, given the big decline in tax revenue we will see in the first quarter of this year, and also maybe in the second quarter as economic activity normalizes. And if the government has to provide any fiscal stimulus, which it should, in my view, to certain segments of the economy, then the ability to spend for government on infrastructure projects is accordingly, limited. Next year, again, the focus will be on bringing down the fiscal deficit to more sustainable levels in order to convince the rating agencies that, we are back on track of fiscal consolidation and so on and so forth. So, I doubt, infrastructure, new investment in infrastructure is taking off anytime soon.
All right, Sanjeev, we'll let you go on that note. Appreciate your time and thanks very much for sharing with us your thoughts.